What's up guys, Ben here and welcome to Motivation to Invest. There is one word which the stock market hates, and that is uncertainty. And it's clear that we live in uncertain times, from political uncertainty to the uncertainty of multiple waves. But for those of you guys that watch this channel regularly, you'll know that there's a famous saying, and that is volatility equals opportunity. So anytime there is uncertainty and volatility in the stock market, that can be a great time to invest. I did many videos about this back in March during the stock market crash, when there was a tremendous amount of uncertainty and fear in the stock market. When this volatility was occurring, that was the time to invest the hardest, and those that did achieved some fantastic returns. Recently, many of the major tech stocks released earnings for Q3 and saw their stocks take a dive, even those with impressive results. So what's the reason for this? Well, many people were buying the rumor and selling the news. With many of these tech stocks already having a major price run up, they were priced for perfection. So any little slip up during an earnings call can cause their stock to plummet. So could this be an opportunity for you guys to invest? Well, I think so. And this week I've actually been buying 3 very special stocks which have plummeted this week. I've been using this uncertain time as a great opportunity to dollar cost average into some great stocks. Now, I'm not going crazy. I'm not investing like I was back in March, investing heavy, but I'm still doing a little bit of light shopping. In addition, I've been following Ark Invest trades closely, and they help me to identify some great buying opportunities. So coincidentally, some of the stocks which I've purchased, Ark Invest has also been buying. So the real question is, do you guys want to find out what these 3 stocks are? If so, let's dive in. So here we are, guys, diving into the latest trades by Ark Invest. You can see there's one that's caught my eye, and there's been quite a few purchases of the stock, and that is Teladoc Health, TDoc. They've purchased 34,000 shares there, making up 0.25% of their ETF. They've also purchased again Teladoc Health, 189,000 shares, making up 0.3% of their ETF. And they've also purchased it again, 28,000 shares, making up 0.2% of the ETF. So it's clear that Ark is very bullish on this stock, and it's one I've been watching for a while. So let's dive into the company and find out a little bit more about it. Right guys, before we get started, if you're new around here, go ahead, hit that subscribe button, join the community if you want more investing tips and exclusive stock market picks, which I'm personally investing into. Also, feel free, give the video a big thumbs up. That really helps out with the YouTube AI. Teladoc is the only publicly listed company in the telemedicine space. Telemedicine is virtual healthcare at its finest, and we know that we live in a virtual world, and that's been accelerated by the global health crisis. So combining technology and healthcare seems to me like a major growth recipe. But I'm not the only one. According to consulting firm McKinsey, up to $250 billion of US healthcare spending could become virtual. The world was already going this way, but now consumer dynamics have started to shift. According to this study, in 2019, 11% of people used telehealth. However, 76% is now interested in using telehealth going forward. This makes complete sense. Who wants to sit in stuffy doctors' waiting rooms when you can just log in to the Teladoc app and organize an appointment with a doctor virtually? They also have a variety of virtual counseling services, which they state has experienced an increase in demand during the global health crisis. And this also makes complete sense, with mental health becoming a major talking point and doesn't have the stigma attached to it, which it used to. Previously, if somebody said they needed to see a psychologist or a counselor, some would say, oh, you're mental or you're crazy. When in today's world, it seems like a normal part of life. And this also makes even more sense because we have gyms to look after our physical health, and a lot of the emphasis is put on our physical health, but our mental health is often overlooked. So a company like Teladoc is in a great position to help people virtually, both mentally and physically. So let's dive into the stock price for Teladoc real quick, and why I'm looking at it right now, because I had my eye on this stock for a while, but recently it's plummeted. So as you can see here, the stock has plummeted by nearly 10%, and it's down $196 per share. Like, bear in mind, let's look back at February. From February, let's say March, it has increased by around 68%. Now, that may seem like a lot, but if you compare that to many of these other companies out there, these technology companies, and even a lot of these healthcare companies, 68% is not massive compared to those. The company's market cap is only $16.57 billion as well, so plenty of room to grow. As I mentioned before on this channel, the larger a company's market cap, the less volatile the stock tends to be, but also the harder it is for the company to continue growing. So why did the stock plummet? Well, that was due to the merger which was recently completed between Teladoc and Livongo. So from day one, investors did not like this merger when it was first announced in August. They were selling off shares both on Teladoc and Livongo. So it's not a surprise to see Teladoc shares backtrack again. Now, I'm not going to get into the details of whether this was a good merger or a bad merger because the facts are it's complete now. So there's no point moaning about it whether it was good or bad. But it seems that Teladoc seems to have got a better deal than Livongo. So that's great news for Teladoc shareholders. So let's dive into this presentation now and look at the Teladoc and Livongo, a compelling combination. So creates the global leader in virtual healthcare across primary, acute, complex and chronic care, positions combined company to lead the market and set the pace for a rapidly evolving healthcare industry. Establishes a consumer-centric, whole-person virtual care solution, driving better care for consumers at a lower cost. Combines two leading high-growth companies built for scale that have complementary cultures. So Livongo and Teladoc were two of the fastest-growing healthcare companies in the world. Delivers significant financial benefits and value creation for shareholders through clearly identifiable $500 million in run rate revenue synergies by 2025 and $60 million in run rate cost synergies by 2022. So basically they're saying these synergies of the two companies together are going to not only improve revenue but also lower costs. So Teladoc has a track record of lots of value creating acquisitions. So since the 2015 IPO, Teladoc has invested $2 billion in acquiring companies and launched dozens of products and partnerships. So their compound annual growth rate, this is obviously incredible, this is going to blow your minds, between 2015 and 2020 has been 67%. Now that is incredible. Now, of course, a lot of that growth has come from acquisitions, but still, it's incredible growth. As I normally say, a company is a growth stock which grows at least 20% per year. They also have a high client retention rate of over 90%. Cost savings, $372 per client. 85% year-on-year revenue growth for Q2 2020. 92% year-on-year growth in US paid membership. 203% year-on-year growth in total visits. So this is just a brief overview of the Teladoc system. So you've got clinical quality, comprehensive product offering, which is now even more comprehensive with Livongo, scale-driven ROI, data analytics, tech-enabled ops at scale, global distribution channels, and multi-speciality physician networks. So Livongo works with artificial intelligence, and as we know with artificial intelligence, the more data you feed the system, the better it can learn and the more effective it can be. So now it's combined with Teladoc, Livongo has access to all this amazing data. So Livongo uses technology to transform the experience of living with a chronic condition, creates a consumer-first, data-driven digital health experience that's easy to use and puts the consumer in charge. So aggregate. So they look at the information, they collect the information, conditions, behavior signals, preferences. Then they interpret this data, clinical recommendations, potential behavior change. They have Livongo healthcare wearable devices, and you can also use your own Alexa, Apple Watches, etc. So this can be used. So Livongo system is used popularly with diabetes, hypertension, weight management, and behavioral health. They also have massive growth, 113% 2020 year-on-year growth, 75% year-on-year client growth, 94% client retention rate. So over 1 billion virtual healthcare visits are expected to occur in 2020. So it's clear that this is a massive opportunity for both Teladoc and Livongo. So now they're together, they basically form a super virtual healthcare company. So that is why I'm really excited about this stock. However, there are some downsides to the stock. It's massively overvalued. So let's dive into the numbers right now and we'll see why. For those of you guys that don't know, I use Stockopedia all the time to analyze stocks on this channel. I find it extremely helpful. It's a tremendous platform. Each stock is given a stock rank. It allows you to quickly analyze stocks. If you wish to check it out, I have a 25% off discount link. I'll leave that in the link below. Check it out, sign up, and see if it fits your investing style. Let's get into it. So, healthcare, adventurous, large cap, high flyer. So, let's look at these revenues first of all. I talked about the compound annual growth rate, 66.3%. Now, generally, I look for a growth stock to be at least 20% growth. This has got 66%, so unbelievable growth. Nearly $1 billion in revenue expected for 2020, and I can't see why the company can't achieve that. However, it is unprofitable, and that is a major issue for the company. So it's a fast growth stock. They're continuously reinvesting to grow the business, and that is why it's unprofitable. But we can see that here. And what you want to be looking for with these type of growth stocks is that they have a clear path to profitability. Their margins are getting better every time, and they're going to become profitable at some point. So we can see a net profit minus $110 million there, 119 million. It says by 2020 it will only be losing $83 million. So it is improving over time. The margins are also getting better. So as you can see from this graph here, it was around minus 34% in 2014. And now year to date, it's minus 8%. So it is improving its margins. So I can see here, revenues forecast to increase $1 billion for 2020, $1.4 billion for 2021. Analyst consensus of Talidoc, 9 hold, 10 buy, 7 are strong. People here from Credit Suisse, Morgan Stanley, JP Morgan, various other firms. Great company right here. There's no one saying sell, no one at all. But let's look at this current ratio first. Current ratio, fantastic balance sheet. Usually I look for a current ratio of at least 2. This has a 6.52, which means the company has plenty of cash on hand. 6 times the amount needed to pay off its short-term debts. So this valuation, it's not even got a PE ratio, of course, because it's unprofitable. Price to sales, that's usually a good measurement for growth stocks, 19. So you're effectively paying 19 times the company's sales. So that's the risk with this stock. But due to this current correction, I have opened a position up in the stock. Only a small position to monitor, but I will increase this if the stock drops further. Gone into a lot of detail with this one because I've not covered it on the channel before, but just be aware if you are going to invest into the company, because it has run up quite a bit, it may be volatile in the short term, but in the long term, I'm hoping it will have great growth prospects. And now my last 2 stocks, I've spoke about these before, so I'm not going to go into major detail. I'll just list them real quick. The second, we'll dive into the Ark Invest trade, and I'll show you that stock. So we're back in the trades for Ark Invest, and as you can see, they've been purchasing more Spotify technology here, Spotify technology here. They've really been going heavy, purchasing more and more Spotify. So what's the reason for this? Well, this is also a stock which has recently released earnings and didn't beat analyst estimates, and thus the stock has plummeted by minus 10% at least. So as you can see here, it's been a major dip. So from March, it was $121 per share. It shot up 134% to around $165. And now it's down $239 per share. So it's dropped by 10%. It's still up year to date. Let's put this in perspective. It's still up from March, up 100% this year. Company's market cap just $44.61 billion. So the company was predicted to report a 66-cent per share loss on sales of $2.35 billion. So Spotify is another unprofitable growth stock. It's reinvesting its profits into growing the business. However, the company ended up losing 68 cents per share. So that's not a massive dip, but it still is a dip. However, despite the missed estimates, Spotify declared its fiscal Q3 a success, saying the business performed at a high level. They had strong monthly active user and subscriber growth, a recovery in global consumption hours from the record low churn below 4%, better than expected gross margin, and free cash flow of 103 million euros. Monthly active users during the quarter grew 29% year over year, and premium paying subscribers grew 27%. So to invest into stocks, generally analyze a company, you have to look at it from 2 sides. First is the quantitative, so that's the numbers, and second is the qualitative. So that's the brand, the usability, personal experiences with the product. And if I give you some insight into my personal experience with the product, I find Spotify very interesting. I used to use it many years ago. I then got logged out the account. I didn't use it for a while, and then I've recently got it again. I tried to use just the free platform, and it frustrated me so quick. I just signed up for the full paying membership. It's so cheap. You get all the music available to you as you need it. No ads. It's perfect. I find a benefit which may increase the customer stickiness is as you create your own custom playlists and you start to follow people and follow their playlists, you create your own little network there. The more information you put into that network and the more the Spotify artificial technology gets to know what music you like, the more valuable that becomes to the customer. So I can't see myself changing platform to Apple Music or Amazon Music in the future, but those are major competitors. And the issue with those competitors is they have deep pockets and they can leverage their technology on existing platforms. So people that sign up to Amazon Prime, they can use the music platform, or iPhone users can sign up to Apple Music simply. So that is an issue with Spotify, and that may harm their growth in the future, but I still think it's a great company. Now, I did a full stock analysis on Spotify, so I'll leave that in the link below so you can check them out, do your own research, do your own due diligence, and see if that stock fits nicely in your portfolio. And now the last stock on my list is a mega tech giant. Now, I'm going to mention it. I'm just going to put it out there. It's a great stock to dollar cost average in. I'm sure many of you guys are already invested in it, but it has run up massively. And that is, of course, the juggernaut, which is Amazon. So Amazon had a blowout third quarter earnings with its sales growth, which skyrocketed by over 37%, and revenue beat expectations. However, it did say its fourth quarter operating profit would fall between $1 billion and $4.5 billion. But the company did say it's spending more on safety and security and health procedures for its warehouses, so I think that's a great spend, and I would not penalize them for that. They're also the leader in cloud computing with Amazon Web Services, which had $11.6 billion in sales in the third quarter, in line with Wall Street's expectations. So the company now employs over 1.13 million people. Now that is a 50% increase on last year. So you can see how quick this company has grown despite its size. We know with these shutdowns going on, the accelerated trend to shopping online has been increased, and it's just a way of life now. And with the Amazon Prime service improving and Jeff Bezos, who is just one of the greatest CEOs of all time, Amazon is just a fantastic company. But like all these great companies, because I always give you both sides of the argument on this channel, it has got high valuation, and that has put a lot of people off continuing to invest in the stock, because you may not get as high upside as you would by investing into, say, a more risky Teladoc stock. But as this stock is priced for perfection, small slip-ups on the earnings, the stock has plummeted by -6%. So that could be a great opportunity to dollar cost in. Don't go crazy. It's still $3,000 a share. You can use fractional shares if you sign up to, I believe, check out eToro platform. I've got a link below. You've also got Trading 212 where you can get a free share when you sign up. It's still $3,000 a share, but if you're dollar costing average in a portion of your salary or wages each and every month, which I personally do, and I think it's a great way of investing into the market, then it's still a great stock. So that's the 3 stocks I've recently purchased during this volatile madness. So when there's volatility, there's opportunity. But remember, this is not financial advice, so please do your own due diligence, research the stocks yourself, know your own financial situation, and only invest what you can afford to keep in the market, especially through the ups and downs. And I'd love to know your thoughts. Which stocks have you been buying during this major correction, during this political uncertainty, during this earnings blowout? What have you guys been buying? Comment below. I'll join in the discussion. Let's get a bit of a community going. Let's get some chat going in those comments. And if you guys want more investing tips and exclusive stock market picks, which I'm personally investing into, subscribe to the channel, turn that notification bell on, and be sure to hit that big thumbs up button to really help out with the YouTube AI. With that being said, thank you guys for watching this video to the end. I really appreciate all the people who watch this channel. And my mission is really to help everyone as best I can by providing you guys with as valuable information as possible. So have a great day and invest safe.